Forex trading can be exciting. The potential for profits is high, but so is the risk. Without proper risk management, you can lose everything. It's like sailing without a life jacket. You might be fine for a while, but one big wave could wipe you out. Risk management is about protecting your capital. It's about staying in the game long enough to learn and grow. Think of it as the foundation of your trading success. A strong foundation will help you weather any storm. Many new traders focus only on profits. They dream of getting rich quick. But experienced traders know that preserving capital is key. It's not just about making money, it's about not losing it. By managing your risk, you can trade with confidence. You know that even if a trade goes against you, you won't lose everything. This peace of mind allows you to make rational decisions. It's the key to long-term success in Forex. Imagine driving a car without brakes. That's what trading without stop losses is like. Stop losses are orders that automatically close your trade at a predetermined price. They limit your potential losses on a trade. Think of stop losses as your emergency brakes. They protect you from a complete wipeout if the market moves against you. Without them, a small loss can quickly turn into a devastating one. Placing stop losses is crucial, but where you place them is equally important. Set them too tight, and you risk getting stopped out of a potentially profitable trade. Set them too loose, and you're not effectively limiting your risk. The key is to find a balance. Consider your risk tolerance and the market conditions. Use technical analysis to identify support and resistance levels. These can guide you in setting appropriate stop-loss points. The risk percent rule is a simple yet powerful risk management tool. It dictates that you should never risk more than a certain percentage of your trading capital on a single trade. Most traders recommend risking no more than 1 to 2% per trade. Why is this rule so important? Because it prevents you from losing a significant portion of your capital on a single bad trade. Let's say you have a £10,000 account. Risking 2% per trade means you'll only risk £200 on any given trade. This approach protects your capital and allows you to stay in the game longer. Even if you experience a string of losses, your account will still be intact. You'll be able to recover and continue trading. Remember, Forex trading is a marathon, not a sprint. The goal is to grow your capital steadily over time. The risk percent rule helps you achieve this by promoting consistency and discipline. Section 4. Overleveraging, a recipe for disaster. Leverage is a double-edged sword. It can amplify your profits but also magnify your losses. Overleveraging, or using excessive leverage, is one of the biggest mistakes Forex traders make. When you overleverage, you're essentially borrowing a large sum of money to trade. While this can lead to big gains, it also exposes you to massive losses. Even a small market movement against you can wipe out your entire account. Imagine borrowing £10,000 to trade with a £1,000 account. A 1% move against you would result in a 100% loss of your capital. That's the danger of overleveraging. It can turn a manageable loss into a catastrophic one. To avoid overleveraging, use leverage cautiously. Start with a low leverage ratio and gradually increase it as you gain experience and confidence. Remember, it's better to err on the side of caution. Section 5. Risk versus reward, finding your balance. Understanding the relationship between risk and reward is crucial for Forex trading success. Every trade you take involves both. Before entering any trade, ask yourself, is the potential reward worth the risk? A good risk-to-reward ratio is essential. This ratio compares the potential profit of a trade to the potential loss. For example, a 2-to-1 risk-to-reward ratio means you're risking £1 to potentially gain £2. Ideally, you want to look for trades with a higher reward potential than risk. This doesn't mean you'll win every trade, but it means that over time, your winning trades will outweigh your losing trades in terms of profitability. Finding the right risk-to-reward balance depends on your trading style and risk tolerance. Some traders are comfortable with higher risk for higher potential rewards. Others prefer a more conservative approach. Risk management is not about eliminating risk altogether. That's impossible in Forex trading. It's about understanding, managing, and mitigating risk. By following the principles outlined in this essay, you can protect your capital, minimize losses, and set yourself up for long-term trading success. Now, I'd love to hear from you. What are your biggest struggles with Forex risk management? Share your thoughts and experiences in the comments below. Let's learn and grow together.